Hi, welcome back to another podcast with Mr. Hagan. And on this podcast, we're going to look at some practice problems, some sample or examples of calculating income taxes. And we're going to use this three-step process down here that I talked about on a previous video. And that is we're going to subtract away deductions. That's going to be step one. We're going to calculate taxes owed using a tax line. That's going to be step two. And then we're going to subtract away any tax credits. That's going to be step three. And then finally, we'll calculate the average tax rate and the marginal tax rate at the end. So let's get right into it. And so let's do this example here where we have a family of four with two children. And we're going to say that in this family, mom earns $65,000 per year and dad earns $65,000 per year. And we're going to have what's called a standard deduction. So deduction, that's an important word, standard deduction. And in the old tax laws, now this is changing. I'm recording this at the beginning of 2018. And so there's a new tax law that just passed at this time, and that's going to change the way deductions work. It's not going to change the way they work. It's going to change the size of them. But so I'm not going to worry about that right now. I'm going to say the older tax deduction was around $12,000. It was actually like $12,700 or something like that. But we're just going to use the number 12,000 here just to keep things simple. So we're going to say you get a standard deduction of $12,000 for a family, for what's called married and filing jointly. So since we have a mom and dad, they're married and they're filing their taxes jointly. And then they also get a deduction for their retirement contributions. So let's say that they decide that they're going to put $10,000 into retirement accounts. So these retirement accounts, these can be things like what's called a 401k, what's called a 403b, or what's called a traditional IRA. We're not going to get into all the details of those things right now, but I'm just going to say that these are the names of different retirement accounts. There's other ones too, 457s. There's various different things, but these are kind of the big ones. And so people, if they put money in these retirement accounts and they can invest those in stocks and bonds and all kind of different things, they get a tax deduction. And that's what's important to us right now. They get a tax deduction on any of those retirement contributions. For money that they put into retirement accounts, they get a tax deduction. So if they put $10,000 into retirement accounts, okay, then they get a $10,000 deduction on their taxes. And then they get a child tax credit of $1,000 per child. Let's say that that's what the law says. That's what the law used to say prior to the changes coming up in 2018. And so let's get into what the math then would look like. Step number one, we said, was to subtract deductions from your gross income. All right, so the first step in all of this is to calculate your gross income so that you can subtract away your deductions. So gross income, dad made $65,000 a year, mom made $65,000 a year. So that means their total income is $130,000. So we would record that right here. And by the way, I would recommend doing this with me. So you should write this down as I'm doing it. Write all this down. Step number one, $130,000 of income. And now we subtract away any deductions they get. So we said they're going to take a standard deduction of just $12,000. And we said they're going to get a deduction for putting $10,000 into retirement accounts. So that's going to be minus $10,000. Okay. And so I'm going to do this calculation while you're doing the calculation. 130,000 minus 12,000 minus 10,000 gets me to $108,000. $108,000, and that is called, that number after you subtracted away your deductions, that's called your taxable income. Okay, that's the amount of your income that is available for the government to tax. So that's kind of cool. They earned $130,000 of income, but only $108,000 of that is actually going to get taxed. Okay, that's what deductions do for you. That's powerful. You earned $130,000 of income, but only $108,000 of that is actually going to be subjected to taxes. Okay, that's step number one. Step number two is we're going to create this thing I call an income tax line, okay? And their taxable income is going to be at the top of that line, which was $108,000. That was this, okay? That was their taxable income was $108,000. They were at $108,000. That was their taxable income. And then the bottom of your line is 0, okay? And then in between there, we're going to record what are called the tax brackets. So let's take a look at the tax brackets. The tax brackets are right over here. If you're married and filing jointly, which we're going to because this is a married couple, any income from 0 to $18,650,000 gets taxed at 10%. Okay, so we're going to go from any income from 0 to $18,650. Any of that income is going to get taxed up to $18,650. That's going to get taxed at 10%. Okay, just that income is going to get taxed at 10%. So that's going to be important. All right, let's bring the brackets back up. So here's our 15% tax bracket. So once you've made from 0 to $18,650, that gets taxed at 10%. Any income above that starts getting taxed at 15%. So your bracket from $18,651 to $75,900, any of that income gets taxed at 15%. So let's record that. We're already at $18,650, and let's see, we're going to go up to $75,900. That's going to get taxed at 15%. So up to $75,900. So we'll put that here, $75,900. And that money in there is going to get taxed at 15%. That money is going to get taxed at 15%. Now, let's go back to these brackets one more time. Are we done paying taxes for this guy? No, because he made $108,000 or has $108,000 of taxable income. So we got to come back over here and we got to say, all right, he's got some additional income above $75,900. So now he's going to go into the 25% bracket. Now, notice he doesn't go all the way to the top of that bracket. The top of that bracket's $153,100, and his taxable income's only $108,000. So he's going to get taxed at 25% from $75,900 up to $108,000. That part of his income is going to get taxed at 25%. So let's record that. That's going to get taxed here at 25%. Now, here's how you actually go about calculating your taxes. So the way that you do this is we got to say how much income did he earn in each one of these brackets. So how much income was earned in this bracket? Well, you take the top of the bracket, $18,650, minus the bottom of the bracket, which of course is 0. So he made $18,650, and that money got taxed at 10%. And so that means on that money, he's going to have to pay $1,865 is going to be his taxes just for this income in here. Now, he made $108,000, so we got to keep going. His income from $18,650 up to $75,900, that's going to get taxed at 15%. All right, so what do? Well, we take the top of the bracket minus the bottom of the bracket multiplied by the tax rate. So that's going to be $75,900. That's this, top of the bracket, minus, what did I say? $75,900 minus $18,650. That's the bottom of the bracket. And so in here is $57,250 of income. And that's going to get taxed at 15%. So that's going to be times 0.15. And so let me just do that calculation, times 0.15. And that gives me taxes owed of $8,587.50. But we're not done yet, because we have income above $75,900. So we have to go up to our taxable income, which was $108,000. So $108,000 was our taxable income, minus the 75,900. That was the bottom of the bracket, 75,900. And that says that I have $32,100 of income that's going to get taxed at 25% times 0.25. And so let me do that calculation, times 0.25. And that means on that income, I owe $8,025. $8,025. Okay, my next step is I gotta add all these together. Okay, so I gotta add all these together to get a final number. So I'm at $8,025 plus $8,587.50 plus $1,865 down here at the bottom. Add all three of those together, and I get a number, total taxes owed, of $18,477.50. That's a lot of taxes to pay, but we're not quite done yet, because we have one more step, and the last step is to subtract off the tax credit. So how do I do that? Well, I subtract away the tax credit. I take that $18,477.50 that I owed in taxes, and I subtract away the child tax credit. Now, remember the child tax credit, if I jump back here a couple screens, sorry, right here, the child tax credit was $1,000 per child, and we have 2 children, okay? So that means we're going to be able to subtract $2,000 off of our taxes owed. That's for the child tax credit. And so my final tax bill is going to be $16,477.50. That's my final answer. So let's record that down here. My taxes owed are $16,477.50. My average tax rate is I take that $16,477.50, I take that number and I divide it by my gross income, which was $130,000. That was their starting income at the beginning, multiplied by 100. So let me just run that number. So I got $16,477.50 divided by 130,000, and multiply that by 100, and I get an average tax rate of 12.675%. And then finally, what is my marginal tax rate? Well, the marginal tax rate is the bracket that I'm in, which right here, that $108,000 is in the 25% tax bracket. And so I would say that my marginal tax rate is 25%. All right, so that's some tough stuff to do right there. We're going to have to do some other examples of this on some future podcasts, but at least that's our first time through. Hopefully that made some sense, and we'll try this again with some examples on some additional videos. All right, this has been Mr. Hagan on another podcast. Thanks for joining me, and we'll see you on the next podcast.